Right now, an insurance adjuster sitting in a glass office block somewhere in London is like staring at a maritime map of the Middle East. And if they decide to just click a mouse and raise the premium on one specific shipping route, the price of the milk in your fridge is going to go up next month.
Right.
The electricity bill sitting on your kitchen counter will climb. And, the purchasing power of the savings you have sitting in your bank account will just quietly begin to evaporate.
Yeah. I mean, it sounds almost like a conspiracy theory when you frame it that way, but it is purely the mechanics of modern global trade.
Exactly.
We are conditioned to view our personal finances as this closed system. You go to work, you earn a paycheck, you buy your groceries, you put a little away, but your wallet is actually plugged into this massive, highly sensitive, and honestly, incredibly fragile global nervous system.
Yeah, a shock on one side of the planet registers in your bank account almost immediately.
Literally overnight sometimes.
So, today our mission is to trace those exact nerve endings. We are digging into an eye-opening piece of source material today titled The Invisible Cost of Global Conflicts in Your Wallet.
Hmm.
And the text specifically examines the growing geopolitical tensions between the United States, Israel, and Iran, and it maps out the direct route from international conflict zones to your personal household budget.
But before we map that out, we really need to set a hard boundary for our analysis today.
Yes, very important.
We are not evaluating foreign policy, taking political sides, or, debating the historical rights and wrongs of the U.S., Israel, or Iran.
Purely an economic autopsy. We're only looking at how overseas friction generates a financial shockwave.
Exactly.
I mean, think of geopolitics like the weather.
Yeah.
You might not pay attention to a severe storm forming over the Pacific right up until the moment that storm, I don't know, grounds your connecting flight or
Yeah.
destroys a global coffee harvest, and suddenly your morning espresso costs double.
Right.
Today, we are tracking a very specific economic storm.
And to understand how that storm eventually hits your local grocery store, we really have to look at the center of the global energy map.
Okay.
Because when tensions escalate in the Middle East, global markets don't look at political speeches first. They look at the geography of oil. And specifically, they look at Iran's proximity to the Strait of Hormuz.
And for anyone who doesn't spend their weekends studying maritime shipping channels, the Strait of Hormuz is this remarkably narrow strip of water connecting the Persian Gulf to the open ocean.
Yeah, and its significance just cannot be overstated. The source material highlights a statistic that essentially defines the global economy. Roughly one-fifth, so 20% of all the world's oil passes through this single incredibly narrow shipping route.
Wait, 20%. So 1 out of every 5 barrels powering human civilization squeezes through a geographic bottleneck that is, what, only 21 miles wide at its narrowest point?
Yeah, exactly 21 miles,
Yeah.
which makes it the ultimate choke point. And if an escalation in conflict threatens that strait, the disruption doesn't even require a physical blockade or like a military strike on a vessel. The shutdown happens in corporate offices.
Like that insurance adjuster in London we talked about at the start.
Precisely. If I'm an executive at Lloyd's of London and I see military tension escalating in the strait, I am not going to insure a massive supertanker carrying $100 million worth of crude oil.
Right. The risk is too high.
Or I'm going to raise the premium so high that the shipping company simply can't afford to sail.
Okay, so let's walk through this step by step. If that strait actually closes, what happens on day one?
So day one, the insurance vanishes. And without insurance, commercial shipping halts immediately. The ships drop anchor. So literally overnight, millions of barrels of oil are effectively trapped in the Persian Gulf.
So day one is just a sudden administrative freeze in the supply chain. The physical oil is fine, it just can't move.
Exactly. But day two is when the financial reality slams into the global markets.
Because the demand hasn't changed.
Right. You have a situation where the demand for energy hasn't changed a bit. People in Tokyo still need to drive to work, factories in Germany still need to run, power grids in the US still need fuel, but the global supply has just been slashed by 20%.
It's a violent swing of the supply and demand seesaw. Commodities traders see the supply vanish, they panic, and the price of a barrel of crude oil spikes violently.
And while governments, they'll try to calm the markets by releasing oil from their strategic national reserves, that is basically putting a tiny bandage on a massive wound.
Yeah.
The global economy runs on the continuous flow of cheap energy. When that energy becomes expensive, a ripple effect begins to spread outward from the commodities trading floors into literally every other sector of the global economy.
Right, because that panic at the port doesn't stay at the port. This is where the shockwave reaches the listener's front door. We've established the oil spike at the source, but the leap from a barrel of crude oil to the cost of everyday life isn't just about the price of gas at the pump, is it?
No, not at all. The transmission mechanism is much deeper than that. It's practically baked into the DNA of modern society.
Okay, break that down for us.
Well, when oil becomes more expensive, the cost of physically moving anything on the planet goes up. Fueling cargo ships, freight trains, the fleet of delivery trucks dropping packages at your door, all of it becomes vastly more expensive.
And companies don't just eat those costs.
Exactly. They don't just absorb those extra transportation costs. They pass them directly on to the consumer.
But it goes beyond just the fuel in the delivery truck, right? Because oil is like this invisible ingredient in almost everything we touch.
Oh, absolutely.
Take a simple plastic clamshell of cherry tomatoes at the supermarket. If we trace the life cycle of that tomato, it's essentially an oil product.
It really is. I mean, think about it. The fertilizer used in the commercial farming of those tomatoes is heavily derived from petrochemicals and natural gas.
Right, and the heavy machinery that prepped the soil and harvested the crop that runs on diesel.
Yep. And the asphalt on the highway the truck used to transport them, that's a petroleum product.
And the plastic clamshell itself, keeping those tomatoes from getting crushed in transit. Made entirely from petroleum derivatives.
Exactly. Even the massive industrial refrigeration units keeping the produce aisle cold are pulling electricity from a power grid that is likely heavily dependent on natural gas or oil-linked energy sources.
So you aren't just paying for a tomato, you are paying a microscopic fraction of the cost of all the energy used in its entire life cycle.
Which is why, when the price of crude oil spikes, because a maritime strait thousands of miles away is threatened, the cost of manufacturing the plastic goes up. The cost of running the farm goes up. The grocery store's utility bills go up.
So by the time you actually swipe your debit card at the checkout counter, the price of those tomatoes is like 30% higher.
Yeah.
The source material calls this a hidden tax, and I think that captures the feeling perfectly. Ordinary families are suddenly paying a tax to fund the friction of a war they have absolutely nothing to do with.
And in economic terms, this specific dynamic is called cost-push inflation.
Cost-push inflation.
Okay.
Yeah.
And it's a very different beast from the typical inflation we usually hear about. Normally, inflation happens when an economy is booming, right? People have great jobs, their wages are high, they have extra cash, and they're out spending it. That high demand pulls prices up.
Right, the classic too many dollars chasing too few goods.
Exactly.
Right.
But cost-push inflation is sinister because it happens even when the economy isn't booming. Demand hasn't changed. People aren't suddenly buying more tomatoes. The underlying foundational cost of keeping society running has artificially surged due to geopolitical friction.
You just notice that your paycheck, which hasn't changed, doesn't stretch nearly as far as it did 6 months ago. The household budget is just quietly being drained.
Which brings us to a much larger, more systemic danger. When millions of households are suddenly squeezed by this hidden tax, the fabric of the broader economy starts to tear.
Okay, so let's push on that, because it makes sense that household budgets are squeezed. But how do we get from expensive groceries to a crashing economy? How does that turn into a global recession risk?
Well, it starts with behavior. If I'm looking at my own budget and my groceries cost more and my commute costs more, I have to make cuts elsewhere.
Right.
I'm not buying the new television. I'm definitely not going out to the local restaurant this weekend. I cancel the summer vacation.
So spending just dries up.
Exactly.
Yeah.
That behavioral shift is the first domino in a global recession. Because one person's spending is another person's income. When millions of consumers simultaneously decide to stop buying the extras, the local restaurant owner suddenly can't make rent. They lay off a waiter. That waiter now has zero income, so they stop spending entirely.
It's a localized downward spiral that quickly aggregates into a national one. But I want to look at how Wall Street and big business react to this, because the source material dives into the psychology of the financial markets too. The markets don't just wait for the waiter to get laid off, do they? They try to predict the pain.
Oh, they try to outrun it. Financial markets despise uncertainty above all else. They can model and price in bad news if it's predictable.
Right.
But geopolitical instability is entirely unpredictable. When investors see a potential conflict threatening the energy supply, they begin fear selling. They dump assets they consider risky, like stocks in technology companies or retail brands, and they pull their capital into what are known as safe havens.
And by safe havens, we usually mean things like gold, cash, or government bonds. But wait, how does an investor buying a government bond actually hurt the broader economy?
Because it drains the oxygen out of the private sector.
Hmm.
When you buy a stock, you're providing capital to a business. When a stock price tanks because everyone is fleeing to safe havens, a company's ability to raise money basically vanishes.
Wow, okay.
The CEO looks at their collapsing stock price. They look at the volatile news out of the Middle East, and they just freeze.
They realize nobody is going to invest in their new expansion project right now.
So they cancel the construction of a new manufacturing plant. The construction workers who would have built that plant don't get hired. The equipment suppliers who would have outfitted the plant lose a massive contract. Business investment completely stalls.
So you have Wall Street panic directly causing Main Street unemployment. Businesses are terrified to grow, and consumers are too broke from the hidden oil tax to spend.
And this leads to the ultimate trap. Because when inflation runs rampant, central banks like the Federal Reserve in the U.S. or the European Central Bank step in. And they really only have one major lever to pull to fight inflation.
Which is raising interest rates.
Exactly. They make the cost of borrowing money more expensive.
But wait, why do they do that? Under normal circumstances, how does that help?
Well, normally it works. If the inflation is caused by that booming, overheated economy we talked about earlier, making borrowing expensive cools everything down.
Right.
People stop taking out loans for cars, businesses pause, borrowing for expansion, spending drops, and prices stabilize.
But, and this is the crucial part, the inflation we are talking about today isn't caused by an overheated economy. It's cost-push inflation. It's caused by an oil shock from a geopolitical conflict.
Precisely. And so the central banks find themselves in an agonizing dilemma. The prices of goods are skyrocketing, so they feel forced to raise interest rates to fight the inflation.
Right.
But raising interest rates does absolutely nothing to open up the Strait of Hormuz. It doesn't produce a single extra barrel of oil.
It's like trying to put out a grease fire with a hammer.
That is exactly what it's like. And it creates a toxic economic environment known historically as stagflation.
Stagflation.
Yeah, you have high inflation driven by the oil shock combined with a stagnant economy driven by high interest rates. Because those high interest rates don't just affect Wall Street, they hit the consumer directly.
Yeah, I mean, if my groceries are 30% more expensive and I've started putting those groceries on my credit card just to survive the month, the central bank raising interest rates means the penalty on my credit card debt just became punishingly high.
The debt becomes a trap. Auto loans become unaffordable. Mortgages become inaccessible. The central bank is actively crushing the consumer in a desperate attempt to bring down prices that are actually being dictated by foreign policy and energy constraints halfway across the globe.
So the recipe for a global recession is remarkably straightforward. An overseas conflict spikes oil. That acts as a hidden tax, draining the consumer's wallet. Scared consumers stop spending, triggering layoffs. Scared investors drain capital from businesses, halting growth. And the central bank makes debt incredibly expensive, suffocating whatever economic activity is left.
And as the source notes, the larger the disruption in a vital region like the Middle East, the deeper and more prolonged the consequences are for the entire global economic system.
It is a genuinely grim picture. But part of the mission of this deep dive is to arm the listener with knowledge, not just anxiety. The source material highlights a really fascinating behavioral contrast in how different groups of people react when these specific geopolitical shocks hit.
Yeah, there is a massive divide between emotion and discipline here. When the news turns apocalyptic and the stock market drops 20% in a week because of Middle East tensions, the general public tends to panic.
Naturally.
They log into their retirement accounts, they see their net worth plummeting, and the emotional pain just becomes too much. They sell their investments just to stop the bleeding.
But the text points out that ultra-wealthy investors, people like Warren Buffett, do the exact opposite.
They really do. Experienced, highly capitalized investors don't view a geopolitical market crash as a signal to flee. They view it as a massive discount sale.
Wow.
They understand that historically, global markets eventually process and recover from geopolitical shocks.
Okay, wait, I have to push back on that a little. Because it's very easy for a billionaire sitting on a mountain of cash to say, don't panic, look for buying opportunities.
Sure.
But if I'm a regular person watching my retirement account shrink while my grocery bill doubles, fear isn't just a fleeting emotion, it's a rational survival instinct. How can you tell someone in that vulnerable position to just stay disciplined?
It is an incredibly difficult psychological hurdle, and you're right, the fear is completely valid. But the mechanics of wealth preservation demand that we separate a paper loss from a realized loss.
Okay, walk us through that distinction. What exactly is a paper loss versus a realized loss?
Think about the house you live in. If a major economic shock hits and the estimated value of your home drops by 20%, you don't panic and sell your house the next morning for a massive loss.
Right, because I still need a place to live.
Exactly. You know you still have a place to live, and you trust that real estate values will eventually stabilize over the next decade. The loss only exists on paper.
But with a stock portfolio or a retirement account, we see the red numbers ticking down in real time on our phones.
And that real-time feedback triggers our fight or flight response. When the market drops because of a conflict in the Strait of Hormuz, your portfolio has suffered a paper loss. If you hold your ground, history strongly suggests the market will adapt, the crisis will resolve or normalize, and the value will recover.
But the moment you click sell in a panic,
You have realized the loss.
ugh,
You have locked it in permanently. You took a temporary geopolitical shock and voluntarily turned it into a permanent destruction of your own wealth.
yeah, and that's heavy.
And the ultra-wealthy understand this. They keep cash reserves specifically to deploy when the rest of the market is panic selling. They buy the assets that retail investors are dumping at a 20% discount.
So they are essentially absorbing the wealth that everyday people are giving up out of fear.
Yeah.
So the real lesson here isn't just be rich like Warren Buffett. It's understanding that making financial decisions based on geopolitical panic almost always transfers your wealth to someone who remained disciplined.
Exactly. You cannot control the geopolitics.
Yeah.
You have zero influence over maritime insurance rates, the flow of oil, or the interest rate decisions of a central bank. But you have absolute control over your reaction to those events.
All right, let's pull all these threads together. We started with an insurance adjuster looking at a map of the Strait of Hormuz. We saw how threatening 20% of the global oil supply instantly freezes maritime logistics.
Yep.
We traced how that missing oil spikes energy prices and how those costs bleed into the agricultural, manufacturing, and transportation sectors.
And we saw how that creates cost-push inflation, the hidden tax that drains purchasing power right out of the household budget.
We mapped out the dominant effect. Tight budgets force consumers to stop spending, causing localized layoffs. Fearful investors drain capital from the markets, forcing businesses to freeze expansion. And central banks inadvertently crush the consumer with high interest rates in a doomed attempt to fix an energy crisis.
And finally, we examined the wealth gap, how the financial elite use the resulting panic to acquire discounted assets, while the general public locks in permanent losses out of temporary fear.
The ultimate defense against this vast, invisible machinery is financial literacy. Understanding how the gears turn is the only way to prevent yourself from being crushed by them.
Absolutely. When you understand the macroeconomic reality, the news becomes less terrifying and more strategic. You anticipate the hidden tax at the grocery store, you prepare your household budget for the reality of higher interest rates, and you refuse to panic sell your investments when the headlines get dark.
As we wrap up this autopsy, I want to leave you, the listener, with a final provocative thought to mull over, something that builds on the paradox of safety we've uncovered today. Because the source text noted that during these crises, people naturally want to move their money into safe havens, like simple cash. They think sitting on a pile of cash in a basic bank account completely insulates them from the chaos of the stock market and global conflict.
Yeah, it feels intuitively safe. The number in the bank account doesn't go down.
Right. But if geopolitical tensions, supply chain shocks, and the constant hum of cost-push inflation are continuously acting as a hidden tax, quietly devouring the purchasing power of every dollar, is simply leaving your life savings in cash actually the most dangerous long-term risk you could possibly take?
Oh, wow. It is the ultimate paradox of modern finance. In an attempt to avoid the visible volatility of the markets, you subject your wealth to the invisible, guaranteed erosion of inflation.
It really forces you to redefine what safety means in a hyper-connected world. I encourage you to look at your own budget this week. Track where the hidden tax of global friction might already be showing up in your expenses, and think about how the foreign policy news you see tonight will inevitably show up on your credit card statement next month. Thanks for joining us on this deep dive. Stay curious, stay informed, and we'll see you next time.